If you've been following Bill Ackman's actions this year, you're surely wondering, what's going on? In the second quarter, he came out swinging with fresh holdings, large purchases, and a definite conviction. Then the third quarter arrived, and it was all red. Selling, no purchasing. In reality, some of those sales were for positions he acquired in the second quarter. When you witness such a dramatic shift from a concentrated investor like Ackman, it raises serious problems. Why trim positions? He's been very open about his investments. Why cut the stock the most when it has been one of his best performers this year? And why go from strong buying months ago to strategic selling now? To make sense of Ackman's reductions this quarter, you must first understand how he invests. Pershing Square isn't one of those funds that spreads its money among dozens of names just to appear diverse. Ackman manages a targeted portfolio of 10 or 11 firms, each chosen with the expectation of owning it for years rather than months. It's more like choosing a business partner than trading stocks. He searches for companies with straightforward business strategies, consistent cash generation, and trustworthy leadership teams. Once he gets in, he stays in. He lets the winners multiply, and he does not worry when prices fluctuate since the thesis is more important than the chart. However, there is a cost to concentration. When you only have a few names, the winners can develop faster than you anticipate. Suddenly, one or two places take up more space than anticipated. This is where trimming comes in. In the second quarter, Ackman was doing the exact opposite of what we're witnessing today. He was putting new capital to work and relying on things he already believed in. The biggest news was his new position at Amazon, which was significant enough to demonstrate serious determination from the start. He also increased Alphabet's Class C shares, increased a few minor holdings like as Hilton and Hertz, and even sold Canadian Pacific to make place for higher conviction plays. It was a quarter that appeared confident, even enthusiastic. He was establishing, growing, and doubling down on firms that he perceived as having lengthy runways. This is why the shift in the next quarter is noteworthy. When someone moves from aggressive purchasing to reducing across many positions in a matter of months, it's natural to ask what happened behind the scenes. Let's break at what Ackman did in the third quarter. Because on paper, the motions appear straightforward, but the nuances reveal a more complex picture. This time, there were no new holdings, surprise bets, or new ideas in the portfolio. Instead, every single transaction was on the sell side, with all four sells coming from names at the top of Pershing Square's holdings. The smallest trim was in Uber. He sold 30,643 shares for barely more than $3 million. In a position worth billions, that kind of sell hardly shifts the needle, making it appear like a minor adjustment rather than a strategic shift. Brookfield observed a similar tendency. Ackman sold 140,166 shares for around $68.58, totaling almost $9.6 million. When you add it all up, the amount comes to around $144 million. Not particularly large for a fund of his size, but targeted enough to make you wonder why every move was a trim. When you consider the firms behind the cuts, the solution begins to make obvious. When you examine at each company separately, the pattern underlying his reductions becomes much more apparent. These were not exits or warnings. They were minor changes influenced by performance, position size, and the basic fact that even exceptional businesses can grow too quickly within a concentrated portfolio. Alphabet is the simplest place to begin because it was the only trim large enough to matter. The stock had a great run into the third quarter, which increased the weight of his position more than any other stock he holds. Selling roughly 10% is not a sign that someone is backing away. It is the act of locking in gains and preventing a rapidly increasing position from overpowering the remainder of the portfolio. Alphabet's fundamentals have remained unchanged, as has Ackman's assessment of it as a long-term compounder. This is the classic readjustment after strength. The little trimmings convey a distinct story. Take Uber. Ackman has described it as one of the finest quality companies he owns, and he established the position with the purpose of riding its growth for years. Selling less than 1% frees up a few $1 million without jeopardizing the argument. Brookfield and restaurant brands fall within the same category. So the reason for these moves isn't panic or a shift in perspective. It's about control. It is the discipline of shaping a portfolio rather than reacting to it. When comparing all four trims, they all convey the same message. The businesses are robust. The theses were intact, but the position sizes needed to be adjusted. Ackman did not eliminate these roles because the businesses were struggling. He trimmed them because the market around them was changing quickly, And a strategy predicated on concentration requires minor adjustments when large moves occur. That alone hints at what he may be preparing for. By the third quarter, several of his greatest holdings had seen significant profits. Alphabet rallied strongly. Uber's popularity continued to increase. Brookfield and restaurant brands delivered consistent results. And when a few names in an already concentrated portfolio perform well at the same moment, they can quietly consume more space than you'd ever anticipate. Trimming them brings the weight back into balance and reduces the possibility of a single stock dominating the approach. Ackman has always played the long game, which includes having enough room to move when the proper time arises. By taking profits in Alphabet and making tiny cuts elsewhere, he provides himself flexibility. Dry powder he can put to use if markets cool or a fresh concept becomes too wonderful to pass up. In addition, there is the backdrop of a thriving market. Technology valuations have increased. Interest rate expectations have moved. Investors have been in and out of risk assets like they're changing lanes in traffic. In situations like this, the most astute investors ensure they are prepared for whatever comes next. These actions appear to be a recalibration, a means of tightening the screws before the next big pitch arrives. He's not abandoning his winners. He's simply ensuring that he's in the greatest possible position to capitalize on whatever the market has to offer next. So what do you take away from this if you don't operate a multi-billion-dollar fund? Here's what stuck out to me after reviewing this quarter's filings. When a concentrated investor owns a few stocks that are performing well at the same time, the portfolio can shift in unexpected directions. And if you're managing real conviction holdings, you don't want one or two fast-moving stocks to dominate the tail of your entire portfolio. Rather than letting performance dictate the weights for you, a short trim puts everything in line with the strategy. Another thing that stood out was how selective the adjustments were. He did not reconstruct anything. He didn't switch to fresh ideas. He did not hedge. He just tightened the positions that moved the most. That tells me the premise across the portfolio hasn't altered, only the size. And that is the true takeaway here. Sometimes the smartest move isn't to introduce something new or make a drastic change. It is ensuring that your portfolio continues to represent your actual plan, rather than the market's momentum. Ackman is not the only wealthy investor who is withdrawing funds. Warren Buffett has been a net seller for nearly 3 years running. In this quarter alone, he liquidated about $14 billion. To learn more about what he sold and why, subscribe to this channel for the upcoming video.